Hello, everyone. Thank you so much for joining us for another Mortgage Leadership Outlook. Today, we have a very, very special guest, someone who's been just, an unbelievable leader to us as we've gone through this just unbelievable, unprecedented times, which is just the understatement of the year. But before we get started, please, let's get people involved here. So if you have people that should be on this call or should be on this live broadcast, please invite them, get them on here. I would love to see actually, use the tagging system. You could tag them, or you could just share, like I am going to share as soon as we get started here. With us, we have a man that really needs no introduction, but I'm going to do the introduction anyway. Mr. Barry Habib. Barry, thank you so much for joining us. We really appreciate it. So, Barry, if you don't know, MBS Highway, founder and CEO, a two-time winner of the Crystal Ball Award presented by Zillow and Pulseonomics, and also one of my favorites, the 2019 Mortgage Professional of the Year. Barry, thank you so much for joining us.
Thank you. Thank you so much, Ben. Thanks for all the hard work that you're doing and all the information that's really vital that you bring to the industry. You've really been a great leader, my friend. So thanks for everything you're doing.
I really, really appreciate that. And the guidance that you've provided has just been phenomenal. I mean, from, really one of the first things that you did where you had your personal doctor, share actually the medical side of it. So we as mortgage professionals could understand what we're going through. I mean, that was huge. Actually just last week, 2 weeks ago, we had the pleasure of having you, Ivy Zellman, and David Stevens. As a matter of fact, I'm going to show that across if you haven't seen that, there's the link down there. You can watch it if you haven't seen it. Ivy and David and Barry just gave the breakdown of what housing is going to look like. So go check that out. And I really appreciate it. Just right now, if you're getting on this, please share this, tag people, get people involved in this conversation. We are going to take some questions, Barry, one of the reasons that we do these things is just to kind of give some information to our readers, to our viewers, so they can understand what they should be saying to their audience, what kind of communications they should be putting out there. And also, listen, the other thing is, Barry, I've got a lot of questions. To call you during these chaotic times and say, Barry, can you spend 45 minutes with me so I can ask my personal questions would be crazy. But when we put it actually on a stream and we have thousands of people watching, I get to ask my questions, and you, the viewers, get to ask your questions. So please hit the comment boxes. Barry's always great with trying to spy as much information as he possibly can. So just going to start this off, Barry. Where was 2020 headed? So let's pretend actually that the coronavirus did not happen, and we just continued to go on the path that we were going to go on.
Well, in a few different arenas, 2020 was going to be a pretty good year for the mortgage business because rates were headed much lower. We know that. We were right on track for a potential mild recession towards the end of 2020. I know that people kind of look at the stock market and say, oh, the stock market was doing really well, but a lot of that's financial engineering, low rates by the Fed, no place else to put your money, stock buybacks. But when you take a look at underneath the covers, underneath the hood, whatever you want to say, and you say, the fundamentals of this thing, corporate earnings were not there. There was a lot of slowdowns in areas like manufacturing. So there were weaknesses there. And this is after a huge tax break and very low interest rate environment. So the economy was doing okay. I know that everybody says, well, it was booming. It was right. No, not really. It wasn't. It was slowing, if we're real about it. But now the real estate market was booming and was in great shape. And that's one of the bright spots that will lead us out of this, although there are some challenges, but there are some opportunities which we could talk about. The real estate market. Commercial real estate was already kind of, but it's really going to struggle right now. And then when you take a look at the stock market was ahead of itself, was over its skis, misunderstanding the Fed's injection of liquidity for QE. And the the mortgage environment was headed for another banner year and many, many strong years. And I still think we'll get there. We have some landmines in front of us, but we're probably going to be in a position where there will be more business than we can handle for the next couple of years because of the eligibility of people to refinance based upon where rates will be. And once real estate comes back, we're going to come back to a market where you have more demand than supply on the residential side. Although there are some periods of time that it's going to take for us to try and get employment back to normal.
Yeah. So let's talk about that. So today on Master the Markets, which Barry does every Monday, Master the Markets on Mortgage News Network, and today talked about a 20%. So like is 20% worst case scenario? What are we really looking at?
I'm afraid that it could get a little worse than that because, let's just do some math. So there's 160 million people in the labor force. There were already roughly 5 million people unemployed. That would be a 3.5% rate of unemployment based on where we were, right? So, you look at some round numbers. Now, we know that in the past 3 weeks, without hiring anybody else, it's a little less than 17 million people that got added to those ranks of the unemployed through their filings for unemployment claims. So that brings you to potentially a little over 20 million people that are unemployed right now. But I think those numbers are understated because when you look at states like California and New York, which are very populous, their numbers were much lower than the rest of the country. And we think that that's because we're hearing reports all over the country of systems crashing for the unemployment ability for unemployment to be calculated by the states. And that's because many of these systems are antiquated. In fact, the platform for programming that was used was COBOL. And COBOL is kind of antiquated, as you probably know, Andrew. I mean, you're very tech savvy. But did you know that, I could tell you for sure for New Jersey, but there are many other states that are having a call out there for, will anybody help us? Are there any COBOL programmers that could help us because it is not designed? So the numbers are going to be worse than this. So as I said, let's assume that we don't even have any underreporting, which we do. Let's assume that everything works on the unemployment monitoring to actually take in the amount of requests, which we know that it's not working. But let's even say if it was. So we're already over 20 million. How many are we going to get this week? 6, 7, 8. That brings us to 28. And it's not as if it's going to level off from that point. It will continue because as this does get worse, we will see businesses continue to have some struggles. So if we get to 32 million unemployed people, well, that's a 20% rate of unemployment. You'd have to think that it's going to be worse than that. I hope and pray not. I mean, I really pray it's not going to be, but we're going to go through some phases here, Andrew. The phase that we're in now is a lockdown phase. We're going to go to an unlockdown phase, which will be a return to some things, but certainly not everything. We will not feel good about hugging each other at that point. We're still going to be cautious. I mean, you do have seasonality, which will help. You will have potentially in May a therapeutic response that could help as well, but it's not a fix yet. It'll be fixed, God willing. And there's a lot of reason to feel promise about this. By the end of this year, when we do have a vaccine, there are so many different potentials that have such great promise by the end of this year. When you get a vaccine, yes, Andrew, we're going to be up close. We're going to be in crowded restaurants, theaters, bars, hugging each other. And, that's when things will feel normal. But the economy, I think it's a little naive for those who think, oh, it's a V-shaped recovery, which means, it goes way down, right up. How is that going to happen? And I think it's also silly to think a U-shaped recovery. The latter part of this is not going to be a straight line. It'll be in fits and starts, and it will be difficult to have it come online as quickly as we would like to a point where we could say, oh, everything's back to normal. It's just not going to happen that way, but it will continuously get better, and that's a good thing.
Yeah. So we've got a question in the room here. With the state of the industry today, if there was a vaccine release tomorrow that would cure this, how long do you think it would take for the industry to pick up, get back to where we were before COVID-19? And then so there's another part, but answer that. I'll go to the other part of the question.
So as you can imagine, first of all, it's a great question, and it's a really valid question. So the things that are hurting our industry right now are the forced shutdown, forbearance, and the risk of unemployed people not making their payment or going into some sort of default. So those are the risks out there. And because of these risks, you think about the waterfall here. So non-QM, which could be considered the most risk accepted types of loans, were one of the first to have a difficult time. Jumbos, which aren't necessarily of high risk, but there's enough risk there without the backstop so that because of uncertainty, those buyers of those, which don't have the benefit of the government guarantees like Fannie and Freddie do or FHA does, for example, they are taking a much more cautious and conservative approach. Because the real damage here is, forbearance means that you might be out there with no payments for up to a year. And the way that it was done was so interesting and, in my opinion, irresponsible, because you should make people at least prove hardship. Forbearance is actually helpful to the housing market because you don't have all these homes put on that are in foreclosure and put up for sale. And so it's helpful, but they gave a license to be able to abuse it, which didn't make sense to me. But that's what we're dealing with, which is why you have, such risk out there. The jumbo market, which doesn't have loans available for forbearance, still has the risk of default. And the best part of the market really is the FHA market, which has the pass-through assistance, meaning that servicers who have to advance the payments can access a facility, can be made whole. That's been fixed. But for some reason, which we just don't get, Mark Calabria, who's head of the FHFA, who is in charge of the agencies like Fannie and Freddie, has not come up with a similar type of facility. So lenders who close a loan on a conventional transaction are almost playing Russian roulette, because if that loan closes and goes into forbearance before the first payment, then it's not eligible for sale. Or if it's in between, they'd have to buy it back. It's got to sit on their warehouse line. You can't get rid of it on scratch and dent because that market's really kind of gone away in the so it's bad. It's bad. So to say, okay, how long does it take to come back to normal? We want to make sure we navigate through this first. Mm-hmm. And there will be some difficulties in navigating through this. And, I hate to use a bad example like this, but it reminds me of those of you who can relate to, there's a bad intersection and the municipality does not put up a traffic light because it's expensive until there's some bad things that happen there, right? Mm-hmm. So, maybe there has to be some bad things that happen. We pray that that's not the case, but maybe there's got to be some bad things that happen before they come up with a fix. Because after all, the agencies are guaranteeing this anyway. And what might happen is, what if somebody says, hey, screw you, I'm just not going to advance the payments. What are they going to do? They have to guarantee it anyway. So let's pray that Mr. Calabria comes around and that the good people that are out there, like Bob Brokesmith and others, Chris Whalen wrote a beautiful article. You've got a lot of leaders out there that are pressuring Calabria to come around. Let's hope that he hears the message. But how long does it take to come back was the question. So that really depends on how quickly the rate of employment starts to improve. Now, there'll be some areas where you'll get that right away. There'll be some improvement through this interim period of unlockdown. But I think that once a vaccine's there, you'll get most of it back, although not all of it, because certain businesses won't come back. And, commercial real estate, people are going to be more efficient. Restaurants are not that easy to open if it's a bigger chain. So this will be difficult. And let's not forget that all this debt that's being created is an overhang. It's an overhang for us, for our children, for our grandchildren. And this will cause a drag on the economy, which in an interesting way, Andrew, has a downward effect on interest rates because of velocity of money will slow. There is one really scary thing that I'm just going to touch upon that worries me, and it bothered me over the weekend when the Bank of England started printing money, because that's crossing the Rubicon now. Mm-hmm. The Bank of England doing this is the first. Does the Bank of Japan follow? If I pray we never do that. Oh, there you go. The Zimbabwe.
Remember this? The Zimbabwe.
Rhodesia did that. Rhodes, Rhodesia was named after him, which then became Zimbabwe. very quickly, once money printing began, it was a quick road down the pipe of hyperinflation. That's when inflation reaches a level above 50% per year, and then people start offloading money. They don't hold money because you want to just hoard assets, which then drives the price up. And there's so many bad things that happen, and money has to be printed more quickly. People have to demand more income because they have to keep up with it, or it's not worth it for them to work, which then leaves the employer with no choice but to raise prices further, which pushes inflation. It's just a spiral that gets so nasty. If it ever happened here, it would wipe out wealth in the United States. It would be awful. So let's pray we never go down that path. But it just bothered me that the Bank of England did this. And it's something we have to watch out for. So how long does it take? Look, we'll have a very functional market and a very good one for a long time, as long as we can kind of keep the basics there. But look, you're going to have $5 trillion in mortgages that will be eligible to refinance. Whether everybody has a job or this and that will be dependent. But I think the bulk of that you'll be able to refinance. $4 trillion in refinances in a great year, you could do $1.5 trillion. So there'll be enough. There'll be more rain than you have buckets for. And when real estate comes right now should be viewed as a great opportunity for real estate.
Yeah. So, well, dealing with it right now, we're seeing lenders actually are really starting to tighten up the reins. We saw, for some of Chase's business, for some of JP Morgan Chase's business, they went down to 700 score, 80% LTV. So Jim just brought this up. Why are some lenders changing guidelines, and some are business as usual, especially with FHA? Can you comment on Jim's comment there?
Well, FHA, as I mentioned, has that facility. So because it has that pass-through facility, so what's happening is if the borrower does not pay due to forbearance, the servicer can tap into the facility, utilize that, and then eventually gets made whole. It works. That's what we need to happen for Fannie and Freddie. And you'd greatly mitigate it without any cost to the taxpayer if you just said, just show proof of hardship, show that you lost your job, but Calabria didn't do that. But a facility needs to be created. So that's why these markets are functioning. Now, on the jumbo front, because you have the added risk now of if this person loses their job and they don't pay, even on a jumbo loan, although they're not able to get forbearance on a jumbo loan, they could still lose their job and not pay and go into default. That's a real fear, which is why you're seeing a tightening of the guidelines and less risk that's going to be taken on, because you want to make sure you do it at a lower LTV, because if values come down, you want to make sure the borrower has skin in the game so that they don't go into default like we saw in 2008 and 2009. You want to make sure that their income meets the requirements. They've got reserves. Their credit is really good, which shows that they know how to manage through difficult times a little better. So that's why.
Yeah, and I've heard before that while it's not supposed to be a hit on your credit report, there could be lenders that actually look at this and say, "Hey, there is a credit event, even though it's not in the credit report."
It is and it isn't. So you're correct in framing it like this, Andrew. You're 100% correct. So it's not supposed to ding your score. But when you look at payment history, there will be no payments made. And some lenders have already said, if somebody's gone into forbearance and we see there's no payments made, that customer is going to have that borrower will have a difficult time obtaining a loan. And when you look at the low interest rate environment we should be in, and the opportunity that will exist in real estate to buy things on sale for a short period of time, they could be costing themselves a tremendous opportunity for something that gives them no financial gain. It's just a postponement of payment. So there's no financial benefit, but you can be risking a tremendous benefit to you for many, many years.
Yeah, and I'm gonna in a little bit. I want you to break down the math on that. We've got a couple of other questions about the forbearance. So Joanne from YouTube just said, is there an incentive, for the servicers?
No.
No incentive.
No incentive. You don't want that. You want that at all costs not to happen. But if it's an agency loan or a HUD loan, you have no choice. You have to be able to grant forbearance, and then you can try in a waterfall process to recover that immediately after forbearance in some sort of restructure of payments, a modification, or in the case of HUD right now for FHA, could actually have it where the that amount is put into a second lien known as a secretary's lien, which gets tagged alongside the first mortgage and will get paid off when the first mortgage gets paid off.
Got it. Okay. So from Christine Beckwith, thank you for joining us, Christine. Do you think that they will overturn Calabria's decision with the FOC committee? And, if they do, if they don't, what does this look like? So play out that.
So great question by Christine. It's great to see Christine, one of the great leaders in our industry that's helping so many people through this time. So it's really great to see you on here, Christine.
She's going to be on next week. She's going to be joining us.
Don't miss it. Christine is amazing, and we appreciate everything you're doing, Christine, as a great leader in our industry. I don't know how that will be viewed. Calabria right now has the keys to this. Could get pressure from the Treasury Secretary, Stephen Mnuchin, who thus far hasn't wanted to do that. It's obvious by the comments made by Jerome Powell that the Fed wants this to happen. The Fed has been vocal about it in very kind of polite ways, that housing and mortgage is absolutely critical and we need to stand behind it, which is a way to say, Calabria, hey, get with the program. And the Fed will stand behind it. The Fed wants to create a facility to backstop this, but you need Calabria to do so. So, Christine, it's a great question, and that's what we're all trying to do. Now, Chris Whalen wrote that amazing article about fanning the flames right now that so many people have read, and he called for the removal of Calabria immediately. And I know that he's had correspondence. I just got off the phone with Chris. He and I have been longtime friends. We've had many a dinner together. I'm going to have him on a call next week, which I think will be very, very interesting, because Chris is one of the smartest, most well-connected individuals who will give us some really, I spoke to him and I was blown away by the insight. So I think that this will be important. We got to take our hats off to people like Bob Brokesmith and Anthony Casa and Mark Calabria, who are leaders that are really trying to champion this thing. David Stevens is done so much good work too, but they are really pushing and being very vocal to try and get this resolved, and it can be resolved.
Fantastic. So we got another question here from Thomas. So markets sold off pretty good today so far. Is the Fed still purchasing?
Well, yeah, they are purchasing, but we have to look at it in the context of the overall picture, right? So when we got the Fed to slow down their purchases on the 30th, which was, it was a Herculean effort on our part to do that, and really a lot in part thanks to people like you, Andrew, and everybody listening who championed that letter we wrote, and people went way out of their way to get it in front of others, and people like Steve Leisman and Peter Bookvar and John Walden were all very instrumental. So the Fed heard us, and they have a steady hand in there. So when you take a look at today's activity, I wouldn't take that in a vacuum. Look at where we were as a closing price on the 30th, and look where we've been for the past 2 weeks now and a day. And you could see that we have been in a very tight range. And then look at the 2 weeks before that, or the month before that, and you'll see it was nuts before that, right? So it's been a different approach. Yes, the market did sell off a little bit, 44 basis points today. We'd prefer not to see that, but there is some degree of volatility in the market that the Fed's not going to be able to manipulate, and they don't want to overstep and cause margin calls. Believe it or not, the 44 basis points to the downside, that puts a lot of people in the money on their margin calls. And you have to don't think like a borrower, think like a CEO. You have to think about longevity. It's good that the market sells off a little bit for a short period of time, because I'm telling you, I won't give names, but so many leaders were talking to me after the 27th and said, we can't survive another week like this because of the margin calls. It was a precarious position that this industry was in. But we have been able to get that stabilized, thank goodness. But now we've got another issue to deal with, right? So we got to navigate through this minefield now with the forbearance and the advancements of payments.
So, and talking about actually the advancement of payments and the forbearance. So the forbearance, we originally, I think it was great actually that we had government that was being proactive. I think that was a nice thing to finally see. 2008, they were not as responsive. Funny thing is, other thing is, in 2008, if you remember the servicers, they were jammed up because they talked about their COBOL systems that were used to dealing with defaults that were less than 1%, now hitting double digits, and those old systems. But so it was the last time actually in 2008 there was a rush to find Cobalt programmers.
Well, and yeah, that's very true. And if you remember, it was back during that financial crisis and mortgage meltdown that the independent mortgage bankers stepped up to help the banks.
Yeah.
So the banks didn't want the service. So the reward for stepping in and saving us last time to the independent mortgage bankers is a cold shoulder to them today. That doesn't seem very fair.
Yeah. So let's talk about this forbearance. Let's talk about the financial impact for borrowers. This is the stuff. By the way, if you are watching this right now, if you're an originator, this is the time that you grab your pen, do what you need to do. This is the notes you need to take. Record this, do what you need to do, because Barry's going to share with you, exactly what the financial impact is for your borrowers. This is the most important. Everything what we're talking about here. This is like this the next however many minutes about Barry's going to talk about, but Barry's going to break down the financial impact of a forbearance, because it's not a free lunch.
Well, it's not a free lunch predominantly because of what's going on with the overall economy and what it can do to the housing market. If the mortgage market winds up going through a period of time where we're losing products and we're losing, pray not, but some independent mortgage bankers, there's a premium for capacity that we've all experienced already, that no matter what the bond market does, rates don't get translated to the borrower. And that starts to put things like the housing market itself at risk. So the abuses that we see in forbearance could be postponing payments, not saving them any money. But what if it damages the value of their home? Pretty stupid deal, right? This is probably the biggest risk that we have. And we know that people who need it should get it. And that's actually, as we said, a good thing for the housing market, because it helps the housing markets remain stable. But the weight of this could be very detrimental to housing. It could be very detrimental to the borrower because of their credit opportunity, like we discussed. And in addition to that, at least on the FHA, there is a facility, but on the conventional side, if that loan is not brought current somehow, and if the servicer continues to make payments and the investor doesn't get it, and if there is forbearance on this without a facility, that loan isn't going to be on the amortization schedule current, Andrew. So there's going to actually be a cost. If you look at how an amortization schedule works, every payment that's made, the subsequent payment has a greater allocation towards principal and interest. So if you miss payments for a year, well, in year two, you're not in year one, you're the amortization for year two. So when you start making payments again, compared to somebody who had been making payments, you're actually losing money every single month when you're making that payment compared to where you were. So there's a cost for this. There's a hard cost that people will be surprised by. And I think if they knew this hard cost, they might think twice about entering into forbearance when they don't have to. Because if the money's going to sit in your checking account, if you got the money, pay it. You're not going to make money in your checking account, but it's going to cost you in the amortization schedule.
And I know we just talked about this before, but Matthew Gavsey is fellow Long Islander. So I just want to talk about this. You mentioned, will the forbearance negatively impact on the borrower's credit report? Because I'm hearing different answers. So if
there are different answers amongst, but here's what the deal is that it's not supposed to negatively impact your credit score. But that doesn't mean that an investor wouldn't view that negatively when they view your credit report and then they see no pay, because it's going to not show a payment made. So when they view your credit report and they know that you've been in forbearance, I've been told by many lenders that they're not going to touch that loan. They're not going to do that. So, again, the bigger opportunity. The main thing is there's no financial benefit whatsoever for forbearance. There's none. Either the money sits in your checking account And remember, it's not all the money because the principal would have been there, or the principal would have been with the lender. It's only the interest portion that sits in your checking account, getting very little to no benefit. And then after a short period of time, 3 months, 6 months, even if it's a year, so what? That money still has to be repaid at some time in the future. There's very little financial gain on that small sum of money, but the cumulative effect on it has a huge negative impact, as we've discussed, on mortgage and housing. And the small benefit that you have by letting that sit in your account, I mean, it doesn't amount to anything financially. It's just letting it sit there idly if you have the money. Now, if you don't have the money, certainly, yes, do it. But the downside of this is the potential negativity on your credit, of opportunity, and lost amortization buildup on each subsequent payment that you would have made.
Yeah. So I've got actually an email from Dorothy. I've been getting emails from lenders stating that they won't refi borrowers that have a forbearance.
There you go. That underscores exactly what we've been saying. And the rates should be very, very low and very beneficial. Look, right now you have a premium on servicing into the interest rate. What do I mean by that? So if you assume for a moment that servicing were worth a point when it was going to be booked, that you'd value the servicing at a point. If you're not valuing anything for the servicing because the market's dried up right now, well, what's going to happen is you've lost 1 point on that loan. Now, many of us know that you could translate 1 point to about 0.25% in interest rate. So until we stabilize things, there's 0.25% built in. And maybe there's a little built in because of capacity right now too. So once things level off, you will probably see interest rates gravitate to a bit of a lower level. Now, you should know a few things, though. We will have a different environment. When things approach a more normal level, don't be surprised if this is already happening too. Your rate locks get shrunk because we got killed with exposure on longer term rate locks. So you might have a 60-day rate lock, but it might be much more expensive than a 30-day rate lock or a 15-day lock. So you'll have it, but they'll be punitive because now you have to expose yourself for 60 days. And that's what almost put the mortgage industry, at least 55% of it, out of business if had we not gotten that letter I wrote in front of the Fed so they would stop. But that would have really been really, really harmful to us. So we always fight the last war. In the future, I would imagine if you want to take on 60 days worth of risk on that transaction, you're going to have to pay for it. Because if you're going to take a position as a hedge, maybe I don't have to hedge as much and take as much of a short position on that mortgage-backed security or TBA because I have a little cushion built into a 60-day lock. The other thing is that we saw these payoffs cause servicing values to drop dramatically. So again, we're going to fight the last war. So what does that tell you? It tells you don't be surprised if you see prepayment recovery or clawbacks expand to maybe a year. And in addition to that, when you take a look at the way that we're looking at making sure the loans will perform better, you might not have as big an appetite, at least initially, for some of the loans that might be a little bit more aggressive in underwriting. So, there's going to be some things that are going to change. And by the way, another big one is it might start to be more common to pay 1 point on a loan. You'll still have 0 point options, but instead of paying a point being 0.25% better in rate, the differential might be 0.5%, which will incent people naturally to say, oh, well, I'll save 0.5% in rate. Maybe I will pay a point. So I also think it's going to be a little more difficult, Andrew, to do loans where there's no closing costs. And as you know, it's one of the things I championed and started very, very early, back in the early 90s on CNBC when nobody knew what it was about. And I was out there talking about ways to do a loan with no closing costs, and nobody knew how to do it. And it's obviously caught on like wildfire over the last 30 years.
So, Barry, where are the opportunities now? Like right now, it's a difficult time to do anything, but I know people are doing business. Like I'm talking to people that are having conversations, applications are going in. Where's the opportunity right now for the originators that are watching this that they should be focusing on?
I think there's a few opportunities. I think that people looking to purchase real estate, to the extent you can, you're going to see pricing at a more attractive level. And you're also going to find that there are less competitive offers now. Sellers might be a little bit more fearful and willing to give you terms. So from a buyer standpoint, you're about to enter a marketplace for a period of time. You're going to have a window where you can buy real estate like you haven't been able to do in several years. It's been a seller's market and you've had to pony up for it. Well, now you can get it on sale. And that's a good thing from an opportunity standpoint, because it will come back. And it was, listen, real estate was the strongest aspect of our economy. Every single metric was great. And there is simply more demand than supply. So over time, and people tend to live in their home on average 10 years. So you'll look back on this opportunity and say, wow, I did great. Another opportunity will be in potentially in the stock market too, because I think that we did something called the Fibonacci retracement at a 50% level. And we just hit that on Thursday. The market was closed Friday. And as a result, as we kind of anticipated, we started to see a little bit of a downturn today. But there might be a continued downturn leading into a really nice opportunity there. So that you should talk to your financial advisor about, but that could be an entry point. And then over the long term, you'll probably see some benefit there as long as you have a longer time horizon. But it will be a choppy ride. The other area that I think is probably the greatest opportunity is within yourself. Andrew, think about, you were one of the pioneers in this, how you've been out there and with social media and you're consuming all of you listening, you're consuming so much information. There's such a void of information right now. So don't just consume it, talk about it and teach it. The best way to learn, by the way, is by teaching. And get out on social media and talk about it. We create scripts for people with an MBS Highway, and we've got a social studio that turns your computer into a teleprompter. Couldn't be easier. Whether you have us or not, you should be out there as a leader right now and doing things to help people get through this and understand. And whether it be getting information on the virus, or getting information on businesses coming back, or putting out information on when can you expect to see your checks from the government, that $1,200 or the $500 for your kids, or how to calculate how much it is, or whether it's, if you're a small business, how do I get involved with PPP, the payroll protection plan, and what I can anticipate there. There's so much good information. We try and put all this stuff out there, but also how things are impacted in the mortgage arena. So your real estate agents are starving for this. Your customers are starving for this. And if you can get out front, you'll build a following that will transcend this period, and people will continuously follow you. So there's an enormous opportunity for you right now. There are a lot of people that are budding today as, internet or social media personalities that in the future will be, very widely followed, and that will bode extremely well for their business. So that's a really big opportunity all of you have now.
Yeah, it's your actions in these next 6 months will make your next 10 years. So we got a great insight and question here from Ines Perez. In 2008, when the selling side of mortgages were basically given with very lenient guidelines, it created a huge distress in the housing market. Would you agree and say that the currently the forbearance guidelines being so?
Yeah, I get it. I get it here. So Ines, this is an interesting question. It's very different than 2008, because in 2008, a lot of those programs were given to individuals on non-owner occupied properties on 100 LTVs, as low as 580 FICOs, and a tremendous amount of no income, no asset, no job. So people were buying homes not because they had intended to make payments and keep the home. They were looking to take that home and capitalize on a market that was moving up really high, and it was kind of like just a Ponzi scheme almost. That wasn't a Ponzi scheme, but the Ponzi scheme was you take money and then you try and flip it to the next person. And the housing market kind of looked like a house of cards like that to people. So very different. Let me give you some statistics. So there's 128 million households in the United States today. Approximately 65% are owned. 65% are owned. It's really 64, but let's just right around that area. Of those, 40% of those have no mortgage. So those are in great shape. The 60% that do have a mortgage, maybe 61% that do have a mortgage, the average LTV is 53. So people aren't going to walk away from their homes because there's so much to protect. The forbearance issue protects those that really don't have as much of a threshold. But you do bring up a point that at the end of a forbearance period, if we don't have a good transitional system, and I think we will, then it could cause some turbulence. But what I think we have a good transitional system that's not going to put people under duress.
Yeah, and listen, we're not financial advisors here, but not giving financial advice. But Felicia just mentioned this cash out refi to put more money in the stock market for a long game. It's
well, Felicia, you bring up a great point. Hi, Felicia. You bring up a great point. So here's the strategy to the extent you could do it, and I'm not going to be insensitive here because you guys have different constrictive guidelines that you have to go through. And I also understand that there might be some premiums right now on cash out refinances. But here's the thing. We have an amazing tool for cash out refinance and debt consolidation that makes it very easy for the customer to see. And what I would strongly suggest you do is think about cash out refinances again, to the extent you can do them. Okay. But because rate becomes less material, you can literally, I see stories every day of somebody who has a very low rate going to a much higher rate, even 5% on rate, and going from a rate that they currently have in the threes. But by wiping out all their debts, they're saving people $1,700 or $1,800 a month. Remember, the government bailout program is $1,200 once. Here you could save them $1,700 or $1,800 every month. And then to Felicia's point, you could take some cash out, and maybe right now you just hold on to it as a nest egg for a rainy day. So you don't have to sell your stocks to generate liquidity at a 50% discount in some cases, and only do some hand wringing later and say, oh my gosh, I wish I would have held on to it because look, it's doubled after I was forced to sell it. So give them some liquidity. And then maybe they could take that money and invest it if things start to look like there is an opportunity there. But when the crisis eventually subsides and we get a vaccine and we start to see things come back to normal, maybe they don't need that extra $1,700 or $1,800 a month because their incomes come back. Take that and accelerate the payments on the new refinance that you did. And now you'll save them 10, 12, 14, 15 years of payments compared to what they would have had remaining. And now you've built up, over 5 years, an extra $70,000 in amortization, 10 years, $160,000 in amortization. In the 14 years when the loan's completely paid off, you've amortized an extra $300,000. This is such an incredible life-changing opportunity that you have for the benefit of your clients. So I'm glad that you brought this up.
Yeah, great. Thanks. So Bob Wampler on YouTube said this. What's going to hurt the most to the small to regional non-bank lenders and brokers? Will that lead to many existing or being forced to go a different route? So is this going to create a channel where people are going to say, I was this, now I got to be this? So if we remember, 2008, all the brokers became banks.
Mm. Bob, it's good to hear from you, by the way, my friend. And you bring up a very good point. But, this is kind of something that smaller players will be less at risk if they have less servicing exposure. So the exposure here is on the servicing side, right? It's not really on the origination side. You could be a very large player and not have much exposure to servicing. You should be okay. The real risk to those players on the origination side who were not necessarily in servicing, or they could have been in servicing, were the margin calls. So thank goodness we were able to get that subsided. But now the risks are to those in servicing. So everything's relative. If you're a small player and you have a large exposure to servicing, you could be small and have risk, or you could be in great shape being small because you don't have a servicing risk. You could be a very well capitalized large player, and depending on the level of servicing risk that you have, especially that servicing risk that is in the Ginnie area, in the agency area, in Fannie and Freddie, not in the Ginnie area, not in the FHA, because FHA is okay. If you have a large exposure to that, that could be problematic. And if you were doing loans that were, recently done with a first payment default, those are going to sit on your warehouse line. So So you have the risk on the servicing side and you have the risk on the first payment default side. So that could be problematic if you're small or if you're large, because the numbers get bigger as you're larger.
Yeah. So I think this next question is very case by case scenario, but maybe you could shed some light of it. If borrowers are indeed having trouble making the payment, do you think it's better to request forbearance or to withdraw from retirement funds?
Dorothy, hope you're doing well. And this is really an individual question. So, forbearance is designed for people that are struggling, and it should be used as such. You want to avoid a first payment default. So I would say if you're having trouble making the payments, but you have some money in the bank for a rainy day, well, this is a rainy day. If you already have your mortgage and you've been paying it on time, and you want to enter forbearance, that's one thing. But if you really are qualified for a mortgage, you just closed, and then you find out, oh goodness gracious, I got laid off or whatever, I lost my job. Well, you probably should find a way to make that first payment. And then after that, if you have to go into forbearance, then yes, but that's the big thing, is make that first payment.
Yeah, great. Barry, what's this book that we're coming about? I haven't even pre-ordered this. What's if you don't mind, actually indulge us.
I'm so excited. I'm so excited, Andrew. So I'm very proud of the book I wrote. It's called Money in the Streets, and it's up for pre-sale now on Barnes & Noble and on Amazon. So this just happened a couple of days ago. I got to tell you, I was like a little kid. I checked the link several times, make sure it was still there. So it's a very exciting time for me. I wrote the book. I didn't write the book for money. I wrote the book because I really wanted it to help people. My background is really modest, and had my parents were immigrants. We were extremely poor. My mom worked in a sweatshop. My dad, struggled and passed away at a very young age. I was very young. He was a lot older when I was born. So was my mom. I was a complete accident surprise, and kind of threaded the needle between birth control being approved, which I just slid in months before that, by the way, and just before abortion was made illegal. So I made legal, forgive me. So I literally threaded the needle on this one. But growing up really poor taught me a lot of lessons, and I share those lessons. And really, it's designed to help you if you're going through a difficult time, to help you get out of it, but also if you're going to a great time, and help you maximize it and help others. And really, the name Money in the Streets is because of identifying opportunities. Every immigrant knows the story when, people come to the United States, like they say, oh, America's such a great country, and it's so rich that there's money in the streets. All you have to do is pick it up. And then you get that kind of rude awakening. And my mom would tell me the story when I was a young boy, but as I discovered things within business and identifying opportunities, I remember before my mom passed away, I sat with her and I held her hand. I said, Mom, you were right all along. There really is money in the streets. You just have to know how to identify it and pick it up and do good with it. And that's what this book really tries to do, is help you see the opportunities that are all around us every day, everywhere, and do good with it.
Yeah, I agree with it, Felicia. Barry, Habib, not an accident, a blessing to us all.
Thank you.
So. Yeah, everyone, please let's get that copy of Barry's book. So really, Barry, thank you so much. I really, really appreciate it. So, I assume everyone is MBS Highway members. If you're not, come on, it's kind of silly.
We hope you take a look at it. We hope you do. We really try every day to do a really good job and provide you with the tools. But I respect everyone's own decisions and opinions. But we hope you take a look at it, and you can ask someone who's on board. They'll tell you if they like it.
And from what I understand, actually, that was why I've been listening. I believe it was on the Housing Wire interview. You have some tools that you've created, for like calculators for forbearance to kind of to help you with your loan officer or help you with your borrowers talk about this. So just more great reasons why now is a good time to become an MBS Highway if you're not already an MBS Highway member.
Thanks, Andrew. Thanks, buddy. Thanks.
No, fantastic. All right, Barry, we're gonna wrap it up. So thank you so much again for joining us. We really, really appreciate it. We are blessed to have actually you, fighting for us, doing everything we possibly can to make sure actually that we do not actually, we're not faced with 80 LTV, mortgages with rates in the double digits. It's great to have you on our side.
Well, can I tell you guys something here just before we leave, Andrew? And thank you for this. And thanks for all of you for taking your valuable time and spending time with us here. I tell you what, I'm so honored. And you guys have been really, really kind to me. I get notes sometimes, and I'm not ashamed to admit I actually get choked up a lot of times. I've had to kind of like hold it back, just sometimes even doing these live ones too. So, but I want to tell you that it's really important to keep perspective. So every day, I start off my day every day with gratitude because there's so many things that we are so fortunate to have. And listen, I know for you guys, it's hard. You've got everybody tugging on you. First of all, your family is your big concern, and you want to make sure they're safe and healthy. And look, I pray to God that they are for you. But you've got your clients that are stressing you. You've got a real estate agent who's just trying to make sure that deal closes because that's so important to them right now. They're stressing you. You go to your company for help, and not because they don't want to help you, but they're actually putting in procedures to make sure that for the long run that things are safe for you, which gives you a little bit more immediate problems, right? Because we're just trying to survive. So you're not really getting a lot of help. So you got to feel like you're on an island. But it's just important that you just remember all the things that you have that are blessings. And the fact that we have these problems, that's a blessing, because you don't have to look too far to see so many people that don't have work to go to right now, and business owners that don't know how they're going to survive through this and get through it. So I know that this is not an easy time for you, but we are really, really lucky right now. So thanks to all of you. I appreciate you. God bless you guys and your families. Please stay safe.
All right, great. Barry, thank you so much. All right, and everyone, I'm going to just take you out here. Again, please just do whatever you need to do. Get Barry's book. I mean, he's just such a blessing to our industry. And we thank you so much for joining us again. Just great attendance for this. So tomorrow, super excited. We got the great Carl White, the chief coolness officer of Mortgage Marketing Animals. So Carl White will be here tomorrow. He's doing a lot of business. Even in today, we're going to actually get inside about how he's doing that business and get inside the mentality of what these loan officers that are having success today and what they're saying, what they're doing. We got that. And let's later on this week, I almost forgot about that. Wednesday, Mike Tedesco from Appraisal Nation talked to us a little bit about what's going on in the valuation space. And Thursday, Glenn Stearns. Glenn Stearns is going to be joining us on Thursday. Another killer lineup of amazing leaders coming up next week. So thank you so much for joining us. Thank you for just reading our publication, National Mortgage Professional Magazine, going to our events, the Originator Connect events, and watching Mortgage News Network.
I want to tell you that Carl White, I love Carl. That's going to be great. That's going to be a great one.
Yeah. He's always, let me get both of us on here. All right, there we go. Yep. So hopefully you'll be there to join us, Barry. I know you've been nonstop actually with this stuff. Oh, thank you. So by the way, in the links, in the comments, we got a couple of people that have posted the links to pre-order Barry's book.
Oh man, thank you.
I feel embarrassed that I actually haven't got it myself. And thank you, Felicia.
It's okay. That is one of those moments. I'm reading some of these beautiful comments. I don't even have words to tell you. It's really, really sweet. Thank you.
All right, Barry. Thank you so much. Everyone, we'll see you guys tomorrow, 4 o'clock East Coast time, 1 o'clock Pacific time.